Well, hello. This is Prashant Kumar from Cashflow Champs. All right, let's get started. Today, we are going to talk about understanding syndication structure. This is a very vast topic. We will try to go into as much detail as everybody wants to know. It all depends on how much you can take it. We will give you general idea of how it works. But again, depending upon the questions and answers, we will go deeper into the details. First of all, folks, I'm not an attorney, not a financial advisor, or a tax advisor. The purpose of this webinar is information purposes only. You should seek professional advice from appropriate personnel. I'm just going to deliver what we can, what happens in the industry. But if you have specific scenarios, you should be discussing with appropriate professionals. And if you need us for something, you can contact us. You can schedule a call with us and we can go over your particular situation. But remember that we are not professional advisors. Just a little bit of logistics. You have two. Yes, Annie said that, yes, you will have recording available to everybody. Guys, we will send the email out. If you have registered for the webinar, you will get the recording for sure, 100%. In Q&A box, try to put your questions and I will try to take them after our presentation. And try to avoid chat because that is distracting. Just put your questions in Q&A box. All right, so let's get started. Once again, as I said, just a little bit about myself. I'm Prashant Kumar. I live here in Long Island, New York. I have two kids. I'm managing partner in Cashflow Champs. I have been a consultant in IT industry for more than 25 years. Our team size as Cashflow Champs is more than $146 million. We about 1,600 plus doors in our current portfolio. I'm a co-host of Cashflow Champs Real Estate Podcast. I personally have had 2,000 units in past in my personal portfolio. I currently own about 1,000 of them. My passion is to help others, in different ways, but one of it is multifamily and assisted living. I am an ardent meditator. I spend a lot of time meditating. That's my personal hobby. So anybody needs anything, any advice on meditation, I'm here for you. By the way, I'm also a trained meditation instructor. I do that free of charge for everybody around the world. I have a small group of folks who are connected to me. So if anybody needs a little bit of advice, training, I do that free of charge, absolutely free of charge. Again, just a little bit about ourselves. We have free underwriting sessions, the middle barcode, every Saturday at 4 p.m. Eastern. And we have a big group. A lot of people join us. Feel free to scan this barcode, the middle one. If you want to learn, if you want to become an active investor in multifamily space, this is a great resource, free of charge, no selling or anything. Saturday 4 p.m. every Saturday. We have been doing that for the last 3 years. One of our managing partner, Charles Seaman, is doing that. We have multifamily coaching that we offer to active investors. That is the rightmost barcode, cashflowchamps.com/coaching. If anyone is interested in knowing more about coaching, how can you compress your growth trajectory from 3 years to 1 year. You know, we guarantee that you will become general partner in a deal within 1 year, or we will continue to coach you until you get into a deal. So something for you to think about, consider. Scan the rightmost barcode, QR code, cashflowchamps.com/coaching. Or if you just want to talk to us, you know, as a passive investor, the leftmost QR code, cashflowchamps.com/schedule a call. So feel free to take the screen print of this, scan it. If you are an active syndicator, underwriting sessions are the best for you. If you are starting in this business, you know, coaching is something that you may want to think about. And if you are a passive investor or you just want to talk to us, you know, feel free to schedule a call with us. These 3 QR codes will give you everything. All right. So today, what are we going to cover? As I said, it is a very vast topic. This is for active investors. Today's topic is for active investors, but it doesn't hurt for passive investors to know how we work behind the scene. A lot of work that goes on behind the scene. We'll talk about that. We'll talk about the type of partners. We'll talk about, you know, structures in LLCs. You know, a common structure in LLC. You know, every transaction is different, but we'll just discuss what a common multifamily syndication deal would have. So we'll discuss that. We will discuss the common documents involved in the syndication business, and behind the scene, you know, how sponsors get paid, what is the split. We'll discuss that. We will share some examples. So, you know, let's see, and we'll discuss a lot more. So we are here to discuss. If you have any questions, please feel free to put it in the chat window. So again, what are the different kind of partners that we have in syndication business? We have a team of general partners those are the general partners who are responsible for managing the whole deal, right? So team of general partners typically have a sponsor. A sponsor is the one who is running the deal. And then there are some folks who are, you know, who are providing their track record, a key principle. And there are some folks who are investing in the deal. So a group of people who are actually running the deal, a group of people, or maybe one person who is the key principal, and the group of people who are limited partners who are investing in the deal. So limited partner is mostly a passive role, but sponsors or general partners, and in some cases, key principal also is an active role, basically, in the deal. So once again, these sponsors, I mean, same person could be a sponsor or a KP or an LP also in a deal, but they could be different as well. So it is a very fluid way of doing it, but these big businesses, you know, companies like Cashflow Champs, we call ourselves as the sponsors. And our job is to find a property, put the property under contract, put earnest money deposit, and we work with other investors. We raise money, you know, we work with the bank, and we run day-to-day operations of the property until we exit out of the property. So there are really 2 scenarios. One is pre-closing and one is post-closing. One is acquisition. Basically, pre-closing is acquisition, in which we are finding the property, which is, most of you know, is a very tedious job. We look at hundreds of properties and we find one of it. You know, the ratio is 100 to 1. We look at 100 deals, then we find one in which we which we bring to our investors, basically. So we find the properties, we put the property, and we do the contract negotiation. We put the earnest money deposit, and basically, then we start going out. We start raising money from our investors. We work with bank. We do all the underwriting, and we work with insurance companies. We work with contractors, right, to see what are the upsides. So all that work is done. And then once the property closes, and then during that working with the bank, we need a key principal, KP, typically affectionately known as KP. We use their track record. I mean, if it's a smaller deal, which we can handle ourselves, we don't need an outside KP. We don't go out. But if we are doing a deal which is bigger than the net worth of the primary GPs, then we sometimes have to go out and look for a key principal who is willing to sign on the loan with us. In most scenarios, these loans are non-recourse, but in some bridge scenarios, these are a little bit, recourse loans also. But net worth and the liquidity of the KP is considered during the a loan approval process. Bank looks at that. So, and then, all this is going parallelly. We are talking to investors to, because we need equity. Some of it is put in by the GPs or KPs or the sponsor, and some of the from outside investors. So once again, as I said, these sponsors or GPs, they find the deal, they do the contract negotiation, they source the debt, they work with legal, they do the all due diligence, they put the business plan together. And then, pursuit capital is put in, basically in the sense, acquisition expenses, liabilities, or earnest money deposit, capital is raised, and the KP does the loan balancing. Loan KP actually signs on the loan, he's the balance sheet guarantor, and then the sponsor does the asset management. So these are the bigger the deal is, more complicated it becomes. So mostly these syndicators, people like us, they don't get involved in smaller deals because the amount of work is same, whether it is 100 unit or 170 unit or 200 unit. The amount of work to acquire a deal is approximately same. If it is less than 50 unit, that's a different ball game. But if it is more than, more than 70, 80 units or more than 100 units, whether it is 100 unit or 200 unit, it really doesn't make too much difference in terms of the amount of work that is needed to close the deal. Equity limits are different. Type of people involved, general partners involved, they are different because their net worths are needed. A lot more work is needed to raise more equity. But if it is a smaller deal, that's a different story altogether. So we are talking about a little bit larger deal, anything above 100 units. That's the purpose, we get involved in. So the primary documents when we look at the deal are, offering memorandum from a broker, the trailing T12, which is a P&L statement, and the current rent roll. Remember, these three documents are the most important documents for us to review a deal. Anytime a deal that comes to us from a broker or an offshore, not offshore, off-market deal, these three documents give us most of the information about a deal, about a multifamily project. What is the offering memorandum saying? This is 1970s built. It tells you what kind of rents are there. It kind of gives you the narration that rents are below market. It gives you the comp. It gives you the market comps. Basically, the current market rent is $750, but the seller has not raised the rents. things like that. So all those things, all the information is present in the offering memorandum. In addition to that, we look at, last year, trailing 12 P&L and the current trend roll. These three things help us to underwrite the deal. Once the deal has been put in contract, the important document that is out there, once the deal is in a contract, the important document that is out there basically is private placement memorandum, PPM. We love this document because this document actually tells our investors that the sky is going to fall apart. It's going to give you all the risks that investors should be aware of. And to me, it's more of a scary document. If I read it and if I follow it, I probably would never invest. But I mean, it's just trying to establish some base guideline that there's possibility that you may end up losing money also. So all that is written, but in real estate, basically, if an asset is bought, the asset never goes away, right? So we always have some valuation of the asset. So it talks about what is our business plan, how much equity is being raised, and what are we proposing to do over the next couple of years in this project. So private placement memorandum contains a lot of information, and it is typically written by an SSC attorney, and because we do have to file, we have to do the blue sky filing for all the investors from different states. So private placement memorandum is needed. Then operating agreement of the company in which investors would be investing money alongside us, right? So we set up the operating agreement, and then basically a subscription document is needed to subscribe to that operating agreement. So we create a operating agreement, and then investors subscribe. Investor says, you need $5 million. I'm going to put $100,000. That's a subscription document. They are subscribing to this deal by signing on a subscription document, and we give them the receipt that they have paid, they have invested this much money alongside us. So basically, for investors, we do the offering memorandum. For our investors also, we do webinars for our investors, and they like it. They do the soft commit, and then in the end, they subscribe. Basically, they sign on the subscription document, they wire the funds, and we close the deal. At the year end, we generate K1s. These are partnership returns. We file for the returns, and we'll give them K1 for our investors, including ourselves, basically. So those are the documents. These are the typical documents at a high level. There could be many more depending upon the complexity of the deal, but at a high level, these are the primary documents that are involved in any syndication deal of mid-size. I'm not talking about 500 units and those kind of deals, because they involve many other documents depending upon the complexity, whether the pref equity is there or a family office is there, and they come in and goes on and on. This is a complete ocean in itself. But for a smaller deal, mid-sized deal, these are the typical documents that are very common. So let's see, what are the structure typically we would put in, right? We would put in approximately, we will have a borrowing entity, right, where we will own the property, and then we will have two entities, one for investors and one for general partners. So general partner entity, the one on the right hand side in the middle of the screen, 123 GP LLC. This LLC is the manager of the other two LLCs also. Property is owned by borrowing entity, right? That's where the operations are happening. And again, this is a simplified version. this structure is a simplified version, right? So your general partners could be different partners. One could be partner, one could be a sponsor. Partner two could be your KP. Partner three could be your other equity partners. So at a high level, all the general partners of a deal are member of a company, which is the manager of other companies also. And whatever my borrowing entity, whatever my operations company is making, any cash flow or the upside is distributed among the investors, which is Class A members in the screen, and general partners. There's usually some percentage split that happens, and there's some pref returns involved, and I can go as much deep as anybody wants, but at a very high level, let's say Class A member gets 70% of the upside and the cash flow. Class B member gets 30% of the upside and the cash flow, and that 30% is further divided into different partners, because there are multiple people who are involved, or multiple LLCs which are involved on the general partnership side, right? Similarly on the Class A side, there could be multiple entities who are the members who are investing into a deal, or multiple folks who are entering into the deal with us, alongside us, right? So all of them could be Class A members, and any general partner on the left-hand side could be a Class A member also, right? Somebody who's managing the deal, or a sponsor is putting the money in the deal, so they have Class A share as well. At the same time, they have general partnership share as well. 70-30, what you see on the screen is just for an example. This could be 65-35, it could be 50-50. In multifamily world, we have seen anywhere from 60-40 to 80-20 or 85-15. We have seen all kinds of structures. It all depends on the deal, right? It all depends how much general partner has to put in, how much efforts. If it is a slam dunk deal, it could be 80-20, easy deal. When I say slam dunk, it doesn't mean that there's no work involved. It means that it is less complicated. It's easier to manage. It fits in our infrastructure easily, in terms of the reporting, in terms of managing the deal. So in those scenarios, sponsor may say it is 80-20 deal, or a sponsor may say, listen, I'm just going to do 70-30 deal over 7 pref. That's how I'm going to do my business. And they keep their business very methodical, and they say, I'm going to do 70-30 deals. Now, there might be some deals which could be construction deals, right? So they are, or construction or heavy value add or opportunistic kind of deal, where the sponsors need to put more resources, more time. So a sponsor may say it is 50-50 deal, or it is 60-40 deal. So it all negotiation. One person can be general partner as well as a limited partner, Class A member also. I'm saying Class A as limited partner. It all depends, what your attorney defines that class as. Typically, Class A is reserved for investors, limited partners, and Class B is your general partner. And within the Class A, you can have multiple entities, multiple investors. Similarly, on GP side, multiple entities, multiple folks, individual folks, they could come in. So what this structure showing is any return, basically, that is being generated by 1 to 3 equity partner LLC is being distributed 70% to Class A members and 30% to the general partners. There could be some pref involved. It could say that any return being generated, first a pref of 8%, 7% is paid to the Class A members, and after that, whatever is left over is split between Class A and general partners. So there could be many, many more variations. At a high level, best practice 70-30 after 7 pref. 7 pref has been paid to Class A members, and after that, whatever is left is distributed 70% to Class A members and 30% to Class B members. Class B members are general partners. They make some asset management fees, but they make fees on in acquisition side, they make fees on refinance side, and they make fees from exit side also. So there are multiple stream of incomes that general partners get out of the project, but from management standpoint, in the asset management side or in the upside, at least on the cash flow, they get minimal, because 7 pref has been paid and from day one, and then it is distributed 70-30, and that 30% becomes very small number, so during the management of the deal. So any questions, please feel free to put it in QA box. The next thing I would like to discuss, how this GP, so Class A member is simple, everybody's individual, they get their return. Sometimes when we have the sponsorship team, they split the return, whatever money that they get through the acquisitions or through asset management or through closing, that is distributed among other general partners also. So I will give you an example. And again, I'm not an attorney. I'm not advising you how you should run your business, but I'm just giving you what is prevalent in the industry. And we go from, you can tweak it according to your needs. Or if you need more information, call us, schedule a call with us, and we can discuss one-on-one how you should be doing few things. So that 30% that you saw in previous screen, considering that as $100, and basically there are different partners involved in the deal. The base example, as I said, so at a high level, I divide my deal into 3 parts. One is asset management, one is acquisition, one is asset management, and one is equity. I divide my deals always into 3 parts. The general partner, 1/3 is assigned to the acquisition, because a lot of work happens to acquire a deal. 1/3 is 1/3 of the general partnership is assigned to acquisition, 1/3 is to asset management, and 1/3 is to the equity. So if you look at it at a high level, my equity partner is about 30%. Then my asset management, I think on this screen I said 20, but I really like to do it at 30%. And then basically key principle is, then you have acquisition, which means, somebody who has brought the deal to the table, who has put the EMD, is 10%. Key principal gets 10%. So at a high level, that's how my structure is. 1/3 for acquisition, 1/3 for equity, and 1/3 for asset management. And that kind of gives, I will update this slide. I apologize, I did not pay attention when I was writing it, but 30% for the equity, 10% the key principal, maybe 10% for the risk capital, 20% for the acquisition, and then 30% for the asset management, 30 to 35% for the asset management. So you can take out 10% from the key principal and put it into the asset management. Basically, that's the change on the base example. So 30% for the equity, 10% for the key principal, 10% for the at-risk capital, 20% for other acquisition related work that we do, who brought the deal, who's working, and stuff like that, and 30% on the asset management side. Can there be different variations? Yes, if you see there are other variations that could happen. It's all up to you how you want to run your business. Maybe you don't need a key principal. Maybe you want to just give key principals only 5%. Maybe you want to, finding the deal was a difficult thing in your business. Maybe you want to give higher percentage to the acquisition people. Maybe at-risk capital was not that much. Maybe you want to give only 5% to that. So all that is dependent on your business. I must tell you, I'm just giving you very high level information. It all is deal specific. Typically, my formula is 1/3 for equity, 1/3 for acquisition, and 1/3 for asset management. And within that, we can go up and down a little bit to make sure we are not doing any injustice with any skill that we need in the team. So that's just my our way of putting it together. As I said, this is what we have for today. But in addition to that, I would say once again, if you want to have underwriting sessions, if you are an active syndicators and want to learn more about underwriting, please scan the QR code that you have in the front of the screen, in the middle of the screen. If you are an active, and if you want to be an active investor, want to learn more of multifamily, compress your timeline, your growth timeline from 3 to 5 years to 1 year, we almost guarantee that you will come into a deal within 12 months. Else we will continue to coach you for as long as you need, right? If you just want to talk to us as a passive investor, please feel free to schedule a call with us. So yeah, that's all I have. Let me see. I can take a few questions now. Yes, I answered you. You will get the recording. Deepak is asking, if an investor is providing funds from 1031, where would they be in the structure? Okay, that's a very good question. Deepak, let me go back to the slide that I'm gonna show. So this is the slide I was talking about. So typically what happens in 1031, we do TIC structure, tenancy in common. So what happens is if there is a deal, so you are actually dividing your deal. When you're 1031 involved, you are really dividing a deal where you are saying this investor is bringing 50% of the equity, he will get 50% of the deal, basically right there. So what happens is, so there is typically, and again, I'm not an attorney, but in a TIC structure, you have divided your borrowing entity right into two. It's almost like that, right? And there are no financials involved. There's no split involved. Any return. So if you have $100 and $25 came from TIC, so you are giving 25% deal to that investor. So any return from the property, 25% of that is going to the investor directly. Now that some financials can be built in, but typically this would be one more entity at this level, which will say 25%. So let's say at the borrowing entity, there would be one more level called TIC from investor one. So 25% deals goes to that investor, and then remaining 75% deal, you are doing the syndication. So that 1031 money is not part of the syndication. It is a separate percentage inside the deal, inside the operating company. I'm not the TIC guy, but I can explain it more clearly if you have deeper questions on that. Let's see, what else do we have? Can multiple people be under asset management, acquisition, and so on? Yes, of course. That's how these are. I mean, this is perfectly fine, and this is perfect. This is the structure. One person can be in acquisition and one person can be in asset management, and they cross each other. I mean, same person could be in acquisition, same person could be in asset management also, 100%, so one person, and they can be limited partner as well. So one person can have multiple roles in a project. We are assigning the percentages in our sheet based on the role, not based on the individual, right? So one person, the same guy can be equity partner, he could be a key principal, he could put the risk capital, he could be working on acquisition, he could be working on the asset management side. So he will dip into all the percentages here, right? These are the role based, not the human, not the resource based split. When the deal is set up, so when I say LP investors and Class A are the same thing, basically. In this structure, LP is a Class A member, basically, in this example. So we try to put all the LPs, all the money is coming, all the investment money is coming from one LLC. Now the general partner, in my deal, I always invest. So I'm a general partner as a limited partner also. So it is one LLC typically. Good question, Sharon. Thanks for asking. So in the offering memorandum, so basically the PPM, as I said, so Peter is asking where in the offering memorandum do you include the worst case scenarios and the investment risk and disclaimers. All the disclaimers, all the risks, they go into PPM. When you have a presentations for investors, you do want to explain those risks and disclaimers up to a certain level, but in terms of the documentation, everything, all the possible risks, that's going to fall apart. You may have, you may lose your 100% of invested capital. All the worst case scenarios you could potentially write in your private placement memorandum, PPM. Paul, yes, you will, yes, we can send you the copy of the slide. You will get the live webinar anyway, a recording of the webinar anyway, but if you really need the slide, please send me an email, prashant@cashflowchamps.com. My name, Prashant, Prashant, @cashflowchamps.com. I will send you this presentation. Why is the most common investment amount is minimum of 50 to 100K? Why not 25 to 20K? So let me explain this why. Jonathan is asking this question. If I have a $5 million, if I have a $15 million deal, for an example, and that's our typical sweet spot, right? And most of the investors look for the deals which are 100, most of the syndicators look for the deals which are 100 plus units. Nowadays ongoing price is $100,000 per unit plus. So give and take $15 million deal needs about 30%, 30 to 35% raise, which is about 5 million. Now, if you are raising all 5 million from retail investors, if you are raising 5 million from your retail investors, think about how many people you would be talking to on a day-to-day basis. If your minimum is 100,000, to get to 5 million, you will need about 100 investors, right? And if your minimum is 50,000, to get to 5 million, you'll be talking to 200 investors. It is just the sheer amount of work that is involved. Do you like to talk to 100 investors or would you like to talk to 200 investors? 100 investors, trust me, it's not an easy job to manage 100 investors. When investors are, there could be new investors, you're talking hours and hours with them. And if the moment you reduce your minimum to 20 or 25K, that 200 investors becomes 400 investors if your minimum is 25K. and it becomes 500 investors, it becomes, if your minimum is 20K. So to raise $5 million with a minimum of $20,000 per person, on an average, you'll be talking to 500 investors. You need to have an army of investor relation folks to raise that kind of money. And at the same time, you want to, raise money from those who have money. Also, you don't want to be going into a situation where folks have only 50,000 and then you are raising 20,000 of that from them. We try to avoid those situations where we are taking the only money that folks have. So we want people to come, those who have money, and those who can easily spare 50 to 100,000 to put and invest in a deal. I hope that makes sense. The level of work involved, managing 100 investors versus 500 investors, that's a huge amount of work. I mean, that puts a strain on the project. Richard is asking, would you structure the entities or various parties differently with a syndication fund versus a single property syndicate? Yes. So syndication fund, yes. I mean, I'm not discussing funds today, but yes, for syndication fund would be different. You could have a fund may have a PPM, and fund could invest in the property. So in this example, this is a property structure, right? But if we have a syndication fund, my Class A member, my fund, so the rightmost, the bottom TBD, this one could be a fund. A fund could be a investor in this property. So can it be different? Yes, it could be different. It could be same. It all depends on the structure. I mean, I could have a fund. Let's say Cash Flow Champs fund. This TBD is really Cash Flow Champs fund, and that fund is investing. I mean, is the only investor into this. Basically, the fund could be a Class A member, and then this could be one entity. So this whole thing, borrowing entity 1 to 3. Sorry about that. Let me present it again. So the borrowing entity structure is there, general partners are there, but my fund could be investing into one deal or multiple deals. So, but for one deal, I could have some money from the fund and some money from other place also. So all depends on what you want to do, basically. So call me, connect with me. I can explain more if you want to go deeper into that. All right. Peter is asking how large the deal, number of units or price point should a brand new GP start with, assuming that she already had 10, 15 unit giving experience in the past. Very good question, Peter. You always want to learn your ropes, right? Slowly. So how big can you go? I mean, do you really need to have a 10, 15 unit JV experience in past? No. But if you have had that experience, I mean, in my mind, one can potentially go up to, easily go 100 plus units easily. I mean, I don't see a reason why one should go from 10, 15 to 50 and then so on. See, there is a reason why I say that. After 70 to 80 units, you can hire a full-time staff on the property. It makes sense to hire full-time staff on the property from a management as well as from maintenance standpoint. So after 10, 15 units, one should really be looking at a property where they can afford to have a full-time staff, which could be after 70, 80, 90 units. So if you are into 100 plus range, you should have one staff, which is property management, and one on-site repairman. And as the number of units go up, can you do more? Yes, 100%. You could go to 200 units where you could have 2 property management people and 2 to repair stuff. So it's all up to you. I mean, but I must say that if you have some experience in the industry, 10 to 15 unit, you can easily go up to 100 units or more. Sharon is asking, what is the minimum cap you are buying, and has this recently changed? When projecting future profits, are you lowering pro forma rent projections, or are you staying with the standard increases? Very, very good question, Sharon. Thanks for asking. The minimum cap again depends on the market. We don't define what is the minimum cap, right? Minimum cap is really governed by the market. What we look at, what is the potential in the market, right? So I cannot say the minimum cap is 4 for Austin market, and minimum cap is 6 for some remote market. So that's not something which I can say, but it has changed. Yes, it has changed considerably. In last 1 year, we have seen cap going up a little bit. Again, it depends on the market. Property values, we have seen property values going down in at least in the markets where we are in Sunbelt, 10 to 15% property valuation changing. That has increased the minimum cap 100%, no doubt about it. And when we are projecting our future profits, we are not increasing our rent the way we have been increasing in past 100%. We have to be very, very conservative to make sure that the numbers that we are projecting is gonna give us some returns. Otherwise, it's not about what we are projecting, it's about the conservativeness. Even in spite of we being conservative, would we be able to run this project? That's our approach. And we are trying to be extremely conservative. Over the next 2 years, we are not projecting any rent increases in our underwriting right now. And after 2 years, if the value add has been completed, that's when we are starting to put some rent increase. We go into the value add scenarios only so far, and we are trying to be extremely conservative. Peter is asking, Peter saying thank you. Okay, Peter, you're welcome, sir. Jonathan is asking, how long does it normally take from the time you find a deal that you decide to set up the syndication with a lawyer and the closing time? All right, so we may be underwriting a lot of deals, Jonathan. We underwrite, as I said, 100 deals, then we get to one deal. Normally, it is about 3 to 4 weeks time. Once we have narrowed down on the deal, we try to put our PSA. Then some PSA negotiation takes place, is about 2 to 3 weeks. And then once we are getting closer to PSA for finalization, at that time we involve our syndication lawyer right away. So from PSA, you have 30 days of due diligence, and then 30 days to close. Sometimes, you could have a little bit more to close after the due diligence, maybe 45 days to close, and then possibly 1 or 2 extensions. It all depends on your negotiation. How do you want to do it? And what are the dependencies you have? If it is, normally 30 days for due diligence, 30 to 45 days for close, and 1 extension. So all in all, you would involve your syndication attorney the day you sign the PSA, right? You should be involving them, provided that that you are going to go with this deal for sure, right? So you should have your PPM ready, or you can do that even during the due diligence time period. So total, as I said, about 3 months should be your soups to nut, 90 to 105 days maximum. 60 is normal, 30 days of due diligence, 30 days of closing, but I have not seen a deal closing in 60 days, Typically, it goes a little bit more than that. So you should have some provision of some extensions in your PSA. So Raviraj is asking that there's a possibility of rent decline if the debt itself is around 5 to 6%, 5.5 to 6%, and a lot of A and B assets are still trading around 4.5 to 5.5 cap. How can syndicators do the deal? So basically, if the debt is about 5, so basically syndicators do the value add deal. It's a very deep question, Raviraj, and very good question. Thanks for asking. Syndicators are not just working on the deal for the regular cash flow, right? I mean, they just don't buy the deal and they keep so the primary objective is the value add, right? So you buy the deal at again at whatever cap, 5 cap, let's say, and you put in a little bit of money in the deal and you raise the rents. So your cap has basically your cash flow has your NOI has gone up. You bought it at, let's say, $1 million NOI, and by putting some money in the deal, you have increased the NOI of the deal, right? So NOI has gone up. So even though your debt service was more than your cap at which you bought the deal at, now your cap is higher because your NOI is higher, right? Initially, you bought it at a lower, and I don't think that really happens. But to answer your question in mathematical terms, even if you have bought the deal at 5.5 cap and your debt is at 6, but by doing the value add, you have increased the cap from 5.5 to, let's say, 6.5 or 7. And that's what is your spread, basically. So hope that answers your question. I like this question, very much. Hats off to you, Raviraj. Richard, are you seeing very many lower interest rate existing loan assumption opportunities in the market? See, most of the time that we are seeing, and I answered this question, I think 2 weeks ago also, the deals that we are looking at, most of the deals which are working out, they are working out with the assumption lower interest rate existing loan. Finding a deal with new loan and making it work is very challenging based on the way the market is. Based on the market, it is very challenging. Most of the deals which require new debt, they are not penciling out. The numbers are not penciling out for us. We have looked at maybe 30 deals in January or maybe more. The only deals where we were ready to put an LOI. LOIs were where we had assumption loans, where we had lower interest rate assumption opportunities. With the new loan, although the rates are fluctuating, they went up, 25 basis point yesterday. I do see, because of the lower volume, CBRE decreased their SBL, Freddie SBL rates by 40 basis point. I mean, it's like, it is, even though the Fed is raising the rate, they are decreasing what they're going to charge the end consumer. They are decreasing because looks like there isn't much volume in the industry. Even then, if the rate is high, it's difficult to pencil on the new deals. So what Carlos is saying, good point, Carlos, contact SEC attorney, after your LOI has been submitted. So your choice, good point, Carlos. Very good. I do not see any more questions, guys. We are just about at the time. This is the QR code if you want to register for our next week's webinar. But before that, feel free to connect with us, schedule a call with us. So again, if you are an active investor, you want to learn more of underwriting, free of charge. We've been doing it for 3 years. Go to our underwriting session, which is the middle barcode, middle QR code. If you are an active investor, want to compress your timeline, consider our coaching. And if you are a passive investor, or just want to talk to us, schedule a call with us, So my next meetup in New York City is February 21st, which is third Tuesday of the month at 6 p.m. It is in Kensington Hall. It is not at the same place where we had one last time, not near the Penn Station. It is downtown Kensington Hall by 2nd Avenue, and it is updated in the meetup.com. Thank you so much.